Just to let you know, Cypnio software that was acquired by Integrity Data in June of this year, actually, we had been in the ACA space for a long time, and primarily because we had had some large customers who were using payroll, and they were looking to, when the law first came out, just to look at the risk of having to provide offers of coverage. And as you know, that in the ACA world, the definition of a full-time employee is somebody who, on averages, works 30 hours a week or more. And so at that time, it was all about keeping people below that 30 hours in order to avoid having to have offered them healthcare coverage. And so we did that, and then more and more people came to us with the same questions. And then in February 2014, we launched our first commercial application. Now, that may seem like not too long ago, but in the ACA world, it's a grandfather, because the IRS released its final regulations on the employer responsibility in February of 2014. And about that time, we had about 20 companies actually using this application. And there were some big changes that came about. All of you know that the real issue with the ACA are fundamentally two. And the first one is eligibility tracking. Who do you have to provide an offer of coverage to? And that can be painstaking for people. And so in our solution, what we wanted to do is create it so that we could address the eligibility issue and then look at the affordability of the offer of coverage. And then really the 1095C was just like a W-2. I mean, it kind of flowed through that process. And we're going to print a bunch of 1095Cs, and we're going to show you that entire system. Well, I don't care where you get your payroll done. It doesn't make any difference whether it's Great Plains or some other service. As you can see here, things like standard measurement period, initial measurement period, stability period, all of those have become the vocabulary of payroll and human resources today. There's just no way of avoiding them. They are part and parcel. They're a federally mandated requirement that you live up to. Interesting about this legislation is that it is the first time in the history of this country in which we have mandated that employers provide health care coverage to their eligible employees. Remember, that's a 30-hour rule. Now, when I first read this, there was a concept, and they said, well, not every employer has to do it. It's only applicable large employers. And when you read that, you think of a large employers in this country. You're saying, well, that's got to be 1,000, at least 1,000 employees. That's not true. What it is it's 50 or more. And if you're in a combined group or affiliated group, in other words, you have common ownership or you're an affiliated group, that 50 is not the single entity. That is actually the combined of all the entities together. So that's a pretty low number, 50 or more. I'll talk today a little bit about there's some interim relief for 2015 for 50 to 99. But not only did we mandate that we have to provide health care coverage, employers have to provide health care coverage, we set the affordability standards for an employee's contribution to his or her own coverage. And that's the first time we've ever done that. A couple things you need to know about the ACA. Check date, unlike a W-2 and 940, check date's meaningless. It's all about pay period dates. And whereas the W-2 summary information for the year, 941 has to be quarterly. In the ACA, you're breaking down everything in monthly increments. Who are at risk? If you look at our customer base, you can do like a bell curve, and you start to see what companies really are at risk. And there's some commonality. I mean, people who have hourly paid workforce, lower wages workers, part-time workers with varying schedules, seasonal hiring, and frequent turnover. And so you start seeing in the middle here, the ACA vulnerable industries, you start seeing kind of a grouping that have a high concentration of use within our software. But I think the real thing is hourly paid workforce, especially hourly paid workforces where you may have don't have a lot of control over the scheduling. The way this all works is the IRS has created what's known the AIR system. You're going to hear more and more about that. It's the Affordable Care Act Information Return System. And just to let you know is that if you remember this last year and how it works, on your 1040 line 61, you had a new question ask you if you had had health care coverage for the entire year. If you said no, I always say that it took you to a worksheet that if you're an MIT graduate, you may have been able to figure out. But here's the key, is that if you said yes and it really was no, the IRS has no way of knowing for calendar year 2014. For calendar year 2015, they will, because in January, you will get a 1095B from every insurance carrier that provided you coverage in any month of the year. That goes into the AIR system. The exchanges into the AIR system will monthly tell who got coverage on exchange, and more importantly, did they get a tax credit or a subsidy? And if you've been monitoring the exchanges, the people who get go on exchange and get coverage, it's a high percentage of them, well over 80%, get at least a tax credit, and some get subsidies. And that's important because then you're going to be coming in with your information. And every year you're going to tell by 1095C, submit to the IRS your offer of coverage, who you offered coverage to, and whether or not that coverage was affordable. And by the way, if you decide that you're not going to offer coverage, you're going to do I'll pay the penalty, you still have to report to the IRS on a 1095C. You'll just tell them that you did not offer any coverage. The importance of that is that once that gets in the AIR system, it's cross-referenced with anybody who had gotten insurance and got a subsidy on the marketplace, and that turns on the penalty phase. That activity right there, your submission, and then matching up with somebody who had gotten healthcare coverage on the exchange is what turns on the penalty. And those of you know is that there's two forces here. There's an individual mandate today, and that's happened in 2014, requires everybody to have healthcare coverage, and there's a employer mandate that requires employers to provide healthcare coverage. And as the theory is as the penalties from the individual mandate goes up, and they go up considerably, they were $95 last year, $325 this year, then $695 next year, is that more and more people will be pushed onto employers' coverage. So just to recap here are some of the forms that everybody knows about. It seems like a lot of paperwork for this legislation. If you went on to exchange and got any coverage, you're going to get a 1095A. If you got a subsidy or tax credit, you're going to get a Form 8962. This is just from the IRS. This is as of the end of January, actually. In the AIR system, they spent almost $800 million so far on it. It will be well over $1 billion when it's done. So who has to produce a 1095C for this year? Well, for 2050, every employer with 100 or more full-time or full-time equivalent employees, they must produce Form 1095Cs. Starting in 2016, it goes down to 50 or more full-time or full-time equivalents. By the way, if you're in 50 to 99, you're not going to have to do a 1095C, but there is a submission form called a 1094C that you will have to fill out and send. And all it will tell you is that all you have to say is that you did not lower your number of employees in this calendar year in order to avoid the ACA. And another one that is even a little bit kind of out there is every employer who is self-insured, regardless of the number of employees. So if you have an employee that has 10 people and they are self-insured, they must produce a 1095C. You see here on the right, it mirrors the W-2, by the way, submission criteria. The reason why it's February the 1st is January 31st is a Sunday. But unlike a W-2, not everybody gets an IRS Form 1095C. Only eligible employees get that form. And so there are two measurements that you use to determine your eligibility. The first one is a monthly measurement method, and that says that if somebody works in 130 hours in any 1 month of the calendar year, they are considered full-time from that time and must be offered health care coverage no later than the first day after the next 2 months. So that's the monthly measurement method. Most people who have hourly employees do not use that, and the reason why is that you could have an employee work 130 hours in 1 month, and then the next thing, and then on a special project, and then work 70 hours on average for the remaining of the month. If you're using a monthly measurement method, they would become eligible as soon as they hit the 130. The look-back measurement method is the one that most use, especially if you've got hourly employees. And what that says is that over a period of time, does an employee average 30 hours a week? And if they do, they're eligible and they're put into a stability period. So who gets an IRS Form 1095-C? If you're on a monthly measurement method, anybody that works 130 hours in any 1 month of the calendar year. If you're in a look-back measurement method, those people that were tested and were eligible for health care coverage during their stability period. And then any employee who is on employer-provided health care plan, even if that employee was not full-time in any month of the calendar year. I'm not going to go through this a whole lot, but there's two penalties, as you know. There's the sledgehammer penalty, and that's not offering coverage to eligible employees. As you can see, it goes up every year. For calendar year 2015, that went up from $2,000 to $2,084. Divide that by 12, and you get your monthly multiplier. The first 80 this year are exempt. Going forward, the first 30 are exempt. And the other thing you need to know is that the penalty is not tax. You cannot deduct that as a business expense. So that's the sledgehammer. I totally decide I'm not going to do anything. I'm not going to comply with the ACA. I'm not going to provide coverage to eligible employees. Then comes the tack hammer penalty. And this is a very, if you look at a funnel, this is a really reduced set of people. And what it is where I'm providing at least coverage that provides minimum essential coverage, but either it doesn't provide minimum value or it's not affordable. In that case, you are going to be penalized only for those individuals who went on exchange and got a tax credit or subsidy. So unlike the sledgehammer where you're assessed a penalty on all eligible employees, this would only be applicable to those employees that actually went on exchange, got a subsidy or tax credit. And again, you have an 80 exemption this year, and going forward it's 30. So what do we do? There's really, this is kind of the pie chart of what we do. Eligibility tracking, affordability testing, rehire monitoring. There's rules about when you can consider an employee rehire or a new employee. We're compatible with all supported versions of Great Plains. And we actually sell this product two different ways. One is for people that utilize Great Plains, and we also have it where people do not utilize Great Plains, but use our application to do the eligibility tracking, affordability testing, and the big one, and that's the IRS Form 1094 and 1095-C generation. The other thing that we've done is we create a system in formatted for ACA concepts and calculations, which expose the end user to those concepts in a meaningful manner, and yet shields them from having to do all the number crunching at the end. Because as you go on, these things are, things like standard measurement periods, initial measurement periods, those are all part of the vocabulary that we all have to learn and embrace. Obviously, the thing that we do that is the most attractive to many people is production of the 1095-C and the submission of 1094-C. A couple of differences between this process and W-2s. First off, W-2s allow you to submit departmentally or divisionally. The ACA requires you to consolidate all entities into when you're reporting. So if you have common ownership and you have 4 companies, one of them must be what they call the authoritative applicable large employer, and they will submit totals for all the other entities. So that's a real departure from the W-2, which allowed you to basically be autonomous. That's why one of the features that we have is the ability to consolidate multiple databases. So if you're running payroll on multiple databases, we can consolidate it for the reporting. And the other thing about that is that if you have an employee, shared employees, the eligibility of that employee is not based upon the individual hours they work in any one entity, is to combine hours they work in all the entities. The other one that we do is that the electronic filing. If you have 250 or more submissions, you must file electronically in order to be compliant. And in fact, there is a penalty for not doing that. We look a lot like Great Plains. We're part of the Great Plains system. You're going to see the installation is relatively simple, and I'm going to go through that here in a minute. And I'm going to also show you the Excel templates that we have. The purpose of the 1095-C, and a lot of people get this wrong, the 1095-C is not to validate whether or not an individual got coverage. That's done through a 1095-B. The real purpose of the 1095-C is twofold. First, it tells the IRS whether you have or have not complied with the employer mandate of the ACA by offering coverage to eligible employees. And remember, even if you are a person, a company, and that says, nope, I'm not going to do it, that's perfectly okay. You still have to produce a 1095-C, and then they will, you'll tell them that, no, I did not offer coverage. There's a code for that. The second thing it does is that if somebody had gone on to an exchange, an individual, and gotten coverage and a subsidy or tax credit, it alerts the exchanges to recertify that person. That does not mean that they're going to lose their coverage. That only means that there's a certification process, because that process coverage is based upon modified adjusted gross income. And you may have a situation there where you may have a home-based business that lost a lot of money, and therefore that was real low, and they'd still be eligible for a tax credit or subsidy. Let's go ahead and go on to the system now. When you come into our system, this is the payroll. This is GP 2013 R2, whether it be 2015 or whatever, looks the same. In the navigation pane, we create this called the ACA. In here, this is our system. First off, the only thing you have to do is we're fast setup, and the reason why is that we don't really generate a lot of data for our system. What we're doing is mining the Great Plains data. So the first thing would happen is you come in here and you create this pay codes to include, and these are hourly, derived. And it's important to note this, that everybody's hours are monitored. Whether you're salary or hourlies, you have a requirement to accurately monitor everybody's hours. The good news is about Great Plains is salary employees have always been allocated a 40-hour work week, which is one of the methods that the IRS suggests in converting salary individuals to hourly equivalents. So you come in here and you click on those pay codes, including salary, that you use to track hours. Now, we're used to hours of work, and that's simply a time clock. You punch in, punch out, that hours of work. The ACA is about hours of service. And there are three mandatory, things like paid vacation, paid holidays, paid sick time. Those obviously you track. But there are three mandatory unpaid leave occurrences that you must credit the employee's hours. You don't have to pay them, but you have to credit them hours as if they had worked. The first one is jury duty. It doesn't make any difference if you have a full-time or a part-time employee. They go on jury duty. You don't pay for it. That's perfectly okay. But you must credit their hours as if they had worked. The second one is military deployment. If you have an individual in the Guard or Reserves, they go out, they're deployed. You don't have to pay them, but you have to credit their hours. The third one is the one that's been around a long time, and that's FMLA. And we handle that two different ways. The first way right here is the FMLA setup. You just put in the employee ID, the start and end date, and you can have multiples of these, and that's fine. And what we do there is we just reduce the denominator. In other words, if a person was gone 4 weeks and you had a 52-week measurement period, we only we monitor whether or not they average 30 hours a week in the 48 weeks that they actually worked. But there's a case of FMLA where I could come to you and say, hey, I hurt my shoulder. I need therapy 3 hours a week every Thursday for the next 5 weeks, and I'd like to take that off in FMLA. You don't have to. You do not have to pay me for that time, but you must credit your hours of service. So once you've done this, just this part right here, just click on those things that you track hours on. You're ready to do the first report, and it's this one right here. It's called the full-time employee and equivalents, and I'm going to do this for 2013. That's the most data I have, and I'll just do it for the 2 company. As you can see, I've set up multiple companies in here. I have really 2, and then I have a combined, which combines the 2 together. I'll come in here. I'll go print. Boom. I print up. The importance of this report is this. It's how to determine whether or not you're an applicable large employer. And the way you do that is that if I was to look at this, let's say I wanted to know whether I had to be compliant as of January the 1st, 2014, the mandates of the Affordable Care Act, I would print this report, which tells me my ALE number, because your determination of whether you are mandated to comply with the ACA is your ALE number from the previous year. So in this case, I am a 267 ALE, and therefore I would have had to have been compliant with the mandate come January the 1st, 2014. So that's an important concept. The ALE status is not the current year. It's the previous year's number that determine whether or not you're an applicable large employer. Now, you'll see here where it's broken down into different segments. First thing you notice is that it's broken in monthly increments. And this is the first time with reporting required on a monthly breakdown. And I'm going to just take January. In January of 2013, I had 114 full-time employees. Those are people that inside of the system I categorized as being full-time. Now, employment type is important now, because if you say somebody is full-time, what you're saying is that you you believe that on average from the beginning they will work at least 30 hours a week. And therefore, there's no measurement period. You have a waiting period of no more than 90 days from their start date to provide them access to health care coverage. Okay. That happens at 90 days has to do with the Public Health Care Act, which prohibits insurance companies of having waiting periods longer than 90 days. However, in the ACA world, you will not be penalized with not having offered coverage. As long as you've offered coverage that would commence the first day after their first full 3 months of employment. So, a full-time person starts June 15th, that's not a full-time month. July, August, September is the first 3 full-time months. Therefore, you'd have to offer coverage by October the 1st. We actually give you that in our closing process. We give you all of this, what they call a non-assessment period of time. But if you do not believe, you don't know, reasonably do not know that somebody is going to, on average, work 30 hours a week, then you could classify them as part-time employees, and that's, basically a variable hour employee. Okay, so let's go back to here and talk about this report then. With that in mind, what you'll see here is for the full-time, for the 114, those are full-time employees. Now, the 49 are part-time employees that worked that month at least 130 hours. So I had 49 part-time people in January that worked 130 hours or more. Once somebody works 130 hours, they are considered full-time for that month, and you disregard their hours. Then I had a bunch of part-time people who worked under 130 hours, and there was 11,212 hours. You take that number, you divide it by 120, and you get 93. And that's what you call a full-time equivalent. Add them all up, add them all down, divide by the number of months in existence, and you get, for the year, you'll get your ALE. In this case, it's 267. You will never have to back into that number any other way. There's no reporting. All that, you'll see why. I've had calls, people say, well, I run all these measurement periods and I can't get close to that 267. That's okay. All that purpose of that number is to dictate whether or not you are an at-large employer. And the reason is that these, if you think about it, this is all what happened within a month. But when you have a look-back period, what happens is that you say, okay, that employee may have worked 130 hours and been a full-time for that month, but in another 10 or 11 months, they only worked 60 hours. They would not qualify to be for healthcare coverage. So the number here, 267, is only to determine your ALE status. All right, so let me go here. So that's the first one. Now, the second thing is setting up standard measurement periods. And here is what a standard measurement period looks like. And I'm going to do a 2013 one. What you do is, for employees, you're going to create measurement periods that allow you to test to see whether or not an employee does average 30 hours a week. And by the way, for the purpose of the ACA, 130 hours in a month is considered equivalent to 30 hours a week. And you can have different ones for salary or hourly employees, or you can have different ones by location. You can start your measurement period using the hire date or using the first day of the next month. Most people will use the first day of the next month. And the reason is twofold. One, you are not credited with having offered health care coverage to an employee or dependent unless every day of that month they were covered. The only exception to that is January 2015, as long as you had offered coverage by the first day of the first payroll period for 2015. Other than that, you're not credited with having offered coverage to an employee or a dependent unless every day of that month they were covered. The second reason is that because of that, most healthcare insurance starts on the first of a month. And so in this case, what I did is I set up one that started 10/1/2012 and ended 9/30/2013. It has a 12-month standard measure period. You can have as little as 3 months. You probably wouldn't want to do that because the stability cannot be less than 6 months. And up to 12 months. The rules are that in order for a person to have been tested in the standard measurement period, they had to have worked as of this date and continue for me as of this date. So everybody had to work a complete cycle in order to be tested in this. And then after, this is like a final exam. You either pass or fail. And an administrative period, this period of time, I have that time to assess, make sure all my payroll's done. That would affect that 9/30. Then I determine eligibility. If a person is eligible, I make an offer of coverage. If they accept coverage, I sign them up, and they will be guaranteed an offer of coverage, coverage to healthcare insurance if they accept for this period of time called their stability period, regardless of the number of hours that they work. So it's a pass or fail. By the way, for those people that were required, companies that were required to be compliant as of January the 1st, 2015, this was the most common used measurement out there. Okay, so if the rule is that somebody had to work the entire process, and the theory is I'm going to test these people 9/30/2015, 2016, 2017. What happens when somebody comes in 2013? They're not going to be in here. Do they have to wait till 9/30/2015 to be tested 23 months later? And the answer is no. What happens there is that they get onto their initial measurement period. So where I told you before everybody's hours are monitored, if you think about it, everybody is in one of two different measurement methods. They're either in a standard measurement period, which is for ongoing employees, or they're in their own individual measurement, and that's for new employees. Notice that there's a date here, and the reason is that's tied to their start. Okay, so once you do that, you pretty well created the first your eligibility standards. I come in here, I'll grab this one right here. I'm going to go 09/30/2013. That's the end of my cutoff date. And remember, this is payroll cutoff date, not check date. I print, I go to the screen, and these are the people that are eligible. Anybody that's forecast ACA status of FT, they're eligible for healthcare coverage. I mentioned that we do a lot of this in Excel, and here is that exact same report in Excel. Let's just say that when we first started off, somebody wanted, and I'm going to just turn these off here real quick. Somebody wanted to do this. They said, you know what, I need a way of knowing what people are trending. So I put 05/30. It comes in, it looks actually at the measurement periods you set up in our application, what databases you want to use. You hit refresh, and what it does, it goes out and calculates it. From here, if I was using this as a forecasting tool, I could say, well, all I want to know, I want you to tell me my part-time people that are trending full-time. And that's these people right there. When we did this, it was interesting. We ended up at our very first client, we had a lot of employees, had about 36,000. When we did this, they were fast food franchisees. They create a fairly intricate system using this tool right here to monitor it. And we found when we went back after the first 4 months that of the 695 people, part-time people that were eligible, were trending eligible, 57% of them were trending eligible by less than 2 hours. So, you know, if you're using a 12-month, it's 1560. If somebody makes 1560.25, they're in. If somebody makes 1559.75, they're not. So that's this group of people. That anybody that has part that shows full-time or that's what their classification is. Then you also have people during the same period of time that are in their initial measurement period. So I'm going to use the same thing. It's the same date. I'm going to print this to the screen. And you see this group of people. Now, notice something about this group. They were all hired after 10/1/2012. It's telling you the number of months in their initial measurement period, how many hours they've worked, and what they're forecasted to be, trending to be. Significance here is that when you look at this, you're looking at people that are going to be, you know, whether or not they're going to be eligible. So as you start going down here, you better not see anybody with 13 months, or excuse me, 12 months, because they would have been on the previous report had they been. The final thing, though, is that when you look at our reporting, is that if you think about it, we have this report right here. And I'm going to print this out because this is a report that you must run every month then. And this report tells you who in that month completed their initial measurement period and testing, and whether or not you have to provide them access to healthcare coverage. As you can see, you have one individual out of the 7 who qualified. So at the end of the day, assessing eligibility is this. In my case, at a very minimum, I must print out my standard measurement period analysis report at least once a year. And that's when I finish processing. And then for the 11 months after that, I have to print this report out every single month to see who newly became eligible. The concept of open enrollment are totally gone when you talk about the ACA, because people are coming, are being tested, and they will become eligible month after month after month. And that's it. That's eligibility determination. Now, I'm going to quickly go into benefit codes. You have benefits that you include for healthcare coverage, and you just click on here. And then we go to our plan setup, and this is where we have where everything kind of hits of what goes on to a 1095C. If you looked at the 1095C instructions for that's published for this year, if you look at line 14, how you answer from here to plan covers dependent, those boxes check marked yes or no, and then check dictate what code goes on line 14. That is, that's how it works. Now, a couple of things that you need to remember. You can offer 20 plans. It doesn't make any difference. Really, what you're reporting on is your least cost option that offers minimum essential cover, minimum value. And the reason is that you could have an employee that took a very good plan, but if you calculated their cost for their self-only coverage, it may shoot them out of the affordability standard. However, because you offered a least cost option, that is what you are measured on in the ACA work. And as you can see here, we have that, the least cost. So if I had 20 different benefit codes, no problem. I only need to have one set up here because that's the one that we're going to be reporting on. Now, the law was written kind of strange, and I'm going to talk about safe harbors. The law actually says that you have to provide health care coverage that will not exceed 9.5% of the modified adjusted gross income of your employees. Well, your employees don't give you 1040s. So what they did is they created safe harbors. And the safe harbor says you may not know the modified adjusted gross income, but you do know a lot about your employees. First thing you know is how much you paid them. So the first safe harbor is what we call the W-2 income, and that is and I'm going to give you for this year, calendar year 2015, because it went from 9.5 to 9.56. For 2015, if you're using the W-2 safe harbor, it is 9.56 of box 1 wages on the W-2. Let's just say my box 1 wage is $100,000. It means that you can charge me up to $9,560 for my self-only coverage, not for my dependents or spouse, just for my coverage. Supposing, though, it only costs you $5,000 in order to provide me that coverage. It's perfectly okay. You can still charge me up to $9,560. There's no relationship between the cost of coverage and what you can take out, the employer's cost and what you can take out of the employees. The second one I'm going to talk about is federal poverty line because it's pretty easy. It's the single mainland poverty level, which is $11,660 this year, times 9.56%, and you divide that by 12. And I believe you're going to get $93.77. And so if you're offering the least cost option of $93.77, you have what's called a qualifying offer. There's a lot of brouhaha about it. It's great because you don't have to, give information, financial information. The reality is that it's just a qualifying offer. It's what they term. You're still going to be printing out 1095Cs. The rate of pay is the one that most people use, and it's probably the most misunderstood one. I'll tell you what the law says, and then I'll tell you how people are actually using it. The first is, remember, all of these safe harbors are about maximums. It's the maximum amount that you can take out. So the rate of pay by law says it is the lowest hourly rate of that individual on the plan start date, or if subsequent to that on a month, it goes below that for that month, that lowest hourly rate times 9.56%, times 130 times 9.56%. So it's the lowest hourly rate times 130 times 9.56. The significance of that 130 is that it shields the employers from this swing and volatility of scheduling. Because remember, you have to provide affordable health care coverage. And what that says is that if an employee worked 130 hours during their measurement period, an employer should reasonably expect that during their stability period, they will work 130 hours. So it's really tied to the individual. However, what happens is a lot of people are using it and saying, well, I'm only going to use my lowest wage workers, to keep one constant rate, or I'll use the unemployment, the state employment, or the local employment. You can actually have different safe harbors calculations by location. And so, again, it's all about maximum. And then you'll tell us whether or not it's a least cost plan. Are you self-insured or not? If you're self-insured, and only if you're self-insured, do you have to keep dependent information? We'll show you that. What the self-only cost is, and that is what is the cost, the employer cost, employee cost for self-only coverage, and what the percentage, the affordability percentage was at the start date. All right. Now we're going to bring this all together. We do a year-end close, just like you do here. And if you say yes, when you do a year-end close, it will ask you, are you eligible for non-calendar year transition relief for 2015? That's only for 2015. And what that says is if you have a health plan, it does not end. It was not a calendar year plan. In other words, it didn't start January the 1st, 2015, and it was in existence December 27, 2012. And you did not make any changes to the plan. You do not have to comply with the ACA in 2015 until the renewal of the plan in 2015. So let's go back now and bring it all together. I come over here, and I'm going to look at this person right here, Fiona. Fiona Kingsley, I'm going to talk about her in a minute. I want you to remember she is a part-time employee. She was hired 5/25/2012. When you get our application, you get these two boxes. The first one is this monthly hour breakdown. If you look at her in 2013, she didn't work a whole lot of hours. Remember, I end September. However, in 2014, boy, look at October, she starts working a lot of hours. And in 2014, she really works a lot of hours. So let's print out her 1095Cs. First thing we do is we come over to the IRS form, and I'm going to print it out for 2013. So I come here and I hit print. I go to the screen, and I get this. When you do a close with us, we automatically give you this non-assessment period. Notice this 2D here, that's a non-assessment period on line 16. So she was hired May 2012. So from June 2012 to May 31st, she's in an initial measurement period. So she's in a non-assessment period. Plus to June of 2013 was that 1 month administrative period. You get that. Remember, if you look here, like line 14, it's called an offer of coverage, not necessarily what they accepted. And also, look at line 50, employer's share of lowest cost monthly premium for self-only. That's the lowest cost monthly premium, not necessarily their premium. It's what the lowest cost offer was that provided minimum essential cover, minimum value. And then, as you can see here, she's 2B throughout the process. So let's go to 2014. We're going to print her form here. For the entire year, we made her a qualifying offer. But wait a minute. It says she's on line 16. She's 2B. And in fact, she doesn't even get a 1095C. She doesn't even have to get one. And the reason is this, is that it's when you do this, when you're tested here, that determination is what you report going through your stability period. So what you're tested on in your previous measurement really dictates what you're classified for your 1095C, not the number of hours that you actually worked physically in that period of time, if you're on a look-back measurement method, which is the most common measurement method. I'm just going to go talk about rehiring real quick. The Affordable Care Act. The Affordable Care Act defines when you can classify an employee as being a rehire. One is any employee that was absent for 13 consecutive weeks upon return of service, you can elect, and it's at your discretion. That's the only place in the ACA which the word non-discrimination isn't prominent, is rehiring. It's at your discretion. You could elect to classify them as a new hire. You adjust the hire date, and what happens there is that they, in a sense, rehire on a new initial measurement period. But there's also what they call the rule of parity, and that means that if an employee previously had worked for you for 4 weeks and was absent, and their period of absence was greater than what they previously had worked for you, you can classify them as a new hire upon return of service. So I worked for you for 4 weeks, I was off for 5 weeks, I come back, you can end up classifying me as a rehire. I worked for you for 5 weeks, I was off for 4 weeks, I came back, you can't classify me as a rehire because my period of absence was not greater than my period of previous service. So I want to kind of wrap it up for some questions here. And so let me get back here, and this is the Absolute ACA compliance solution. It provides you everything you saw today, including the generation of the electronic filing. The IRS has not opened up their testing portal as of yet, but it will be later on this month for us to get certified. We won't have a problem in doing that. If you want to know where you're at with the ACA and your knowledge, if you go to sitneo.com, there will be a resource button, or you can just do this ACA-payroll-quiz. It's 20 questions. We have no idea who took it, but we do know kind of what the average is. It's not about our solution. It's just basic understanding of the Affordable Care Act. And then we also have some other resources for you.